What if I told you that the hedge funds shorting AMC are digging themselves deeper every day, while retail investors are just sitting back and watching the chaos unfold? It sounds wild, but that's exactly what's happening. Those betting on AMC's downfall are now trapped, forced to burn cash day after day just to keep their positions open. And the reason is simple. Their predictions were wrong. Dead wrong. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone remember, this is not a financial advice video. Let's start with the core of this situation. Some people placed massive bets assuming AMC would collapse. They believed the movie industry was dead, AMC was financially doomed, and retail support would dry up. But what actually happened was the opposite. AMC is not only still standing, it's fighting back, showing signs of growth, and retail investors haven't budged. They've held firm, refusing to sell. And now, with the company stabilizing, restructuring its finances, and the box office booming again, the people who bet against it have no escape. Let's look at one tweet that sums this up perfectly. Stefan Vikstrom pointed out the obvious irony. Imagine you throw everything on AMC filing for bankruptcy, and then the cinema business begins to rise from the ashes. AMC starts cleaning up its balance sheet, blockbuster releases are locked in for years ahead, and the loyal retail community keeps buying and holding. What do you do then? If you're a short seller, all you can do is double down and throw more capital into shorting a stock that refuses to collapse. This isn't just a theory, it's backed by data. We've seen consistent on-balance volume, retail ownership trends, and insider reports confirming that retail investors have never stopped accumulating AMC shares. On the flip side, short sellers continue to stack up short interest, increase exposure through synthetic positions, tokenized assets, swaps, you name it. They're doing anything to keep up their attack. And here's the kicker. Every single one of those actions costs them money. Real money, every single day. Retail investors, on the other hand, have a different story. They make their purchases, hold their shares, and that's it. No maintenance cost. No endless borrowing fees. The cost of entry is the cost of ownership. But shorting is different. It's expensive, and the longer this goes on, the worse it gets for them. They're paying to hold positions that are not yielding results. They keep betting against AMC, hoping the company will fall, but it's not falling. In fact, the movie industry is thriving. Just take a glance at current box office numbers. We're only a week into August, and the domestic box office has already hit over $1.25 billion. That's massive. That's not a dying industry. That's a rebounding, growing one. AMC, being one of the largest players in this field, naturally stands to benefit from this resurgence. Yet, despite clear signs of recovery and growth, short sellers continue their narrative. AMC is finished. AMC is a zombie stock, but their words don't match the numbers. If they took the time to look beyond their own bias, they'd realize that AMC has made operational improvements, increased efficiency, and continued expanding its revenue streams. Some areas within AMC still need development, yes, no one is denying that. But those betting against the company were hoping it would be buried by now, not thriving with improvements on the way. Now here's the uncomfortable truth for them. They must face what's coming. Because AMC isn't just surviving, it's evolving. Even Wall Street analysts can't deny the shift anymore. Take B. Riley, for example. According to a tweet shared by Tarzan Stock, the firm now predicts AMC will earn 8 cents per share in Q2 of 2025. That translates to roughly $34 million in profit. That's not just a break-even point. That's solid earnings for a company that was written off by many. In fact, some retail analysts believe the actual earnings could be even stronger, up to $80 million or around 18 cents per share. Think about that. Institutions that once said AMC would never recover are now quietly adjusting their forecast to positive territory. But even these modest upgrades likely understate the company's real potential. Why? Because Wall Street still has a vested interest in keeping AMC suppressed. They've invested billions trying to crush the stock, so even when they start to turn positive, they're doing so reluctantly and conservatively. And let's not forget, Wall Street doesn't want retail to win. They don't want this narrative to shift in favor of everyday investors. That's why they've tried to create an illusion, a false sense of security that AMC is still not worth investing in. But despite all of that, retail remains steadfast. You can even see it in how other platforms and services are behaving. Robinhood, for example, is now openly bullish on AMC. And when you observe the consistent net buying pressure from retail, the story becomes even clearer. Sure, they're selling too, but buying outweighs it, always has. And while the share price doesn't reflect this, the reasons are obvious. Dark pools, off-exchange trades, and blatant manipulation have all played a role in suppressing price discovery. Even so, institutions have started scooping up shares. Their quarterly reports show increased positions in AMC. That's not a fluke, that's strategy. They're quietly building up exposure, trying to get in while the price is artificially low. They know a shift is coming. Yet some still claim that shorts can close their positions anytime they want. But here's the thing, they can't. Not at these prices. Why? Because retail investors aren't selling. You can't buy shares that aren't being offered. It's simple supply and demand. Hodling has real consequences, and those holding the line are making it impossible for shorts to close easily. According to a post shared by Stormtruther, the idea that shorts can exit their positions effortlessly is just not grounded in reality. And you can see that with ETFs like XRT being used to short AMC and other stocks like GME. The short interest on XRT was reportedly over 1,300%. That's mind-blowing. And here's what's even more concerning. XRT has landed on the SEC's Regulation SO list due to consistent failures to deliver. That means trades are failing to settle properly, an obvious red flag that the system is under stress. If shorts could cover, they would, but they can't. They're stuck. That's why synthetic positions and shady tactics continue. They're scrambling for ways out, but every path leads to more losses. These are not just random claims or conspiracy theories. These are facts supported by data, patterns, and behaviors observed over years. If short sellers had a way out, they would have taken it long ago. But they didn't, because they can't. So when you see online posts, bots, or trolls saying it's all over, that AMC is done, that shorts are winning, understand what's really going on. It's psychological warfare, a last-ditch attempt to shake retail loose. But retail's not moving. Apes aren't selling. AMC isn't failing. And the clock is ticking for those on the wrong side of this trade. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.